charting the markets on Friday, the 12th of January 2024. Now, earlier this morning, we had UK GDP data surprised to the upside ever so slightly, but this was dampened by a 3-month average, which was actually slightly negative. So the UK may still be heading into a recession. We'll have to see what the numbers will say in the future. But on that note, basically, we saw the FTSE 100, interestingly enough, actually recover from yesterday's falls, which were due to a higher than expected reading in the US inflation data. And you can see here, yesterday, we dropped down to the red line on the FTSE 100 on this daily financial bet to the 200-day simple moving average at 7,574, which acted as support. And from there today, we have so far managed to bounce back and risen. So we have risen to 7,654, but didn't make any headway ahead of this afternoon's US PPI data, and also, very importantly, the beginning of the fourth quarter earnings season in the US, with big American banks such as JP Morgan, BNY Mellon, and Citibank reporting. So technically speaking, the FTSE 100 still looks quite toppish, and if we were to slide further and fall through to yesterday's low at 7,573, we've got some support coming in between the orange line here, the 55-day simple moving average, and the October to January uptrend line around 7,548 to 45. So that's a support area going forward, and that ties in, as you can see here, with the mid-November and early December highs between 7,543 and 35. Now, for the upside to be back in play, what we really need to see is a rise and daily chart close above Thursday's high at 7,694. If that were to happen, then it looks more likely that further upside is in store, which could then take us back up again towards the September and also the December highs around 7,750 or so. And I'd like to look at France today instead of the German CAC 40. And what we can see here is that the French CAC 40 has been trading in a sideways trading range since last week, but is currently trying to overcome its Thursday high at 7,488, and in doing so also break through this minor resistance line. Now, if that were to happen, and if today on Friday, the end of the week, we were to close above that 7,488 high, it would indicate that further upside is likely to be seen next week, which could then take us back up again towards the 7,600, or perhaps even towards the 7,650 area, where we basically formed a new all-time record high back in December of last year. And this view remains valid as long as we stay on a daily chart closing basis above Thursday's low at 7,381. So that's the last reaction low on the daily candlestick, which is lower than the one to its left and to its right. Provided we stay above there, further upside is more likely to be seen than any downward reversal. And if you look at the US, I'd like to look at the small caps for once. And here we've got the Russell 2000. And as you can see here, we've also, like the CAC, been trading in a sideways trading range. And yesterday, on that higher reading with regards to US CPI inflation, the Russell 2000 went all the way down to 1,933, which was marginally above last week's low, 1,921. But in the a pre-opening market session here on the all-session price on the IG platform, we can see that the daily financial bet is trading around the closing levels yesterday. So we'll have to see what happens today, whether we will slide through this 1,933 low and also towards the low from last week, 1,921, which incidentally were made around the September high, and that currently seems to be acting as support. So either we're seeing that, or perhaps we could see a recovery take us back towards yesterday's high on Thursday, made at 1,991. Now, from a technical perspective, that would need to be taken out on a daily chart closing basis. We need to close above there for us to continue this October to January advance and to be heading back up again above the 2,000 area towards the December high 2,078. So the line in the sand really for the Russell 2000 is 1,991 on the upside, and on the downside 1,921 as earnings season kicks off. The UK this morning saw its GDP data out, which came in slightly better than expected with regards to the month of November. And we can see the impact of that on the euro against the British pound. As you can see here, the euro has slid against the British pound, and it seems to be heading back down again towards Tuesday's low at 85.87. And a fall through there could take us back down again towards the December low at 85.50. And you can see here that since the late December high at 87.14, we've been in a very clearly defined, pretty rapid downtrend, which for the last week basically has slowed down a bit, but the trend is still your friend. That's still pointing down, and that will continue to be the case as long as we stay below Wednesday's high at 86.20 on a daily chart closing basis. And if you look at the British pound against the US dollar, we can see further strengths. As you can see here, the British pound has risen since October of last year against the US dollar, more on the back of US dollar weakness as interest rate expectations, as basically these have been pared back with market players still expecting to see a rate cut, the first rate cut by the Fed in March of this year, with about a 65% probability. But the height and the total rate cuts that we expect to see this year have been pared back. And on that note, the US dollar has weakened over the last week, as you can see here, and the British pound has appreciated. But earlier this morning, we now seem to be coming off slightly as the US dollar is gaining traction once more. Now, from a technical perspective, provided we stay above the last reaction low, that's to say Wednesday's low at 126.87, the recent uptrend remains intact, and we may actually try to overcome the mid-December high at 127.94 and also the December high at 128.28 in the coming days. This brings me to the next market, that is to say the US dollar against the Chinese yuan. And what we can see here is that we've traded sideways over the last week around this red line here, the 200-day simple moving average, around 718, and basically not much volatility being seen on this chart here, despite this morning as China's consumer prices falling for the third straight month. And at the same time, we also had imports rising less than expected, but export growth beating forecasts as producer prices in China also fell more than expected. So we can see that the Chinese economy is still struggling at the moment with regards to growth. And on that note, not much has happened with regards to the currency pair here, which is still trading sideways. Now, as long as we stay below Wednesday's high at 7.19, we could see further sideways trading around this red line here, the 200-day simply moving average over the coming days. But if we were to fall through Thursday's low at 7.16.17, we could slip further towards 7.15, 7.14, and so forth. But as you can see here, not much really going on with regards to this currency pair at the moment. The slightly weaker US dollar over the course of this week has had an impact on the gold price. But before we speak about gold, I'd like to mention the price of crude oil, as the US coalition in the Gulf has actually attacked Houthi positions in order to safeguard shipping lanes in the Red Sea. And on that note, the price of oil has risen, as you can see here. We've now broken through the September to January downtrend line with regards to WTI, and are currently testing last week's high at 74.27 on this futures contract, and are heading towards the orange line, the 55-day simple moving average at 74.71. Now, if that were to be exceeded as well, then we would be heading up towards the December high, at the late December high, I should say, at 76.20. And that together with the red line here, the 200-day simply moving average at 77.59, would represent the next upside targets. But in such a scenario, we would also see a medium-term bullish reversal take shape here, which could then take us back up again towards the psychological $80 mark in the coming weeks. So we'll have to really watch that quite closely, because at the moment, yes, we've broken through this downtrend line, but we haven't managed to close on a weekly chart closing basis, that is to say Friday today, above the last week's high at 74.26. And that's what we want to see for at least a short-term bottoming formation to be confirmed from a technical perspective. And this slightly bullish view will remain in play as long as we stay above the current January low at 69.41 on a daily chart closing basis. But I've just mentioned gold, and let's have a look at gold. And you can see here that the gold price has tried to recover ever so slightly on the back of this slightly weaker reading with regards to the US dollar over the last day or two. But on the weakness of the US dollar of the last week, actually, we still had a weaker gold price take us down to the orange line here, the 55-day simply moving average at $2,016 per troy ounce, before we started to rise on this escalation in the Middle East at the moment taking place with regards to Yemen. And we can see here that the flight to safety flows are pushing the gold price slightly higher. And if we were to rise above Thursday's high at $2,051 per troy ounce, we could then head back again towards the high seen back in 2020, 2022, and also in May of 2023. And these highs were made between $2,070 and $2,082, and just above there we've also got the December high, $2,088. But so basically what I'm saying is we've got a really strong resistance area between $2,070 and $2,088 per troy ounce, which may cap any further upside in the short term. But as long as we stay above yesterday's low, $2,014 per troy ounce, further upside looks to be more likely than any downside reversal with regards to the gold price for the next few days. And last but not least, I'd like to mention natural gas prices, which have risen quite sharply over the last few days on a cold snap in Europe and also in the US, and basically therefore more heating being used and that pushing the gas price higher. As you can see here, we rallied last week to 312 on this futures contract and have since come off and traded around this orange line here, the 55-day simply moving average at 283. And continue to do so at the moment as this red line here, the 200-day simply moving average, yesterday acted as support at 273. So basically, as long as that continues, the upward momentum could actually continue, but I wouldn't be surprised if we were to sideways trade with a slightly bearish bias over the next few days, which could then perhaps in the next few weeks, when, and well, not if, but when the weather warms up again, we could then perhaps slip back down again towards the December to January uptrend line, which currently can be seen around the 256 mark. So that's what it looks like at the moment with regards to the asset classes I've just mentioned. Thank you for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.